How to invest £1,000? Let's go. Yo, what's up and welcome to my channel. Today we're talking the best ways to invest £1,000. Before we invest £1,000, let's be really clear on the objective. So by investing just £1,000, which is a nice bit of cheddar, but it will not be enough to make you a millionaire, to get a passive income enough for you to quit your job and retire and live off forever. What we're hoping to do is learn what is a good investment, how to invest, what returns you can expect. Think of this as taking your leap into the investment world. Taking your flag, putting it down and shouting, I'm here to crack deals and invest my money. Number one investment is into knowledge. Put aside 2 to 5% of that initial investment into your formal education. A lot of the resources you're gonna need are online. So this is on YouTube, on blogs, or on Reddit. And the few resources you're gonna have to pay for are in the form of books. I'm gonna recommend 2 books that you have to read. Number 1 is Rich Dad, Poor Dad by Robert Kiyosaki. Number 2 is Unshakable by Tony Robbins. If you read these 2 books, you'll be armed with all the right knowledge to make some killer investments and have the right mindset going into investing. If you wanna check out YouTube, start with someone called Graham Stephan. If you want to go on blogs, Mr. Money Mustache. And on Reddit, there's a forum called FIRE, Financial Independence Retire Early. Your question to me might be, why don't I invest all of that 1K into formal education? The people that are going to suggest that you invest that entire 1K into courses, resources, are the people, the online gurus who actually sell these resources online. Because I actually agree, the best thing you can do with this 1K is spend it on learning. But my idea of learning is learning by doing, learning through execution and getting that real market, that real live market feedback. So the first investment is into your knowledge. Invest 2 to 5% of that £1,000 into books, and the rest of the knowledge you need go on YouTube, forum, and on blogs. Second investment is high risk investments. The one I would recommend is cryptocurrencies. I'd advise allocating 5 to 10% of that £1,000 to high risk investments. 10% is a large enough holding that if it rockets in price, if it explodes, you're gonna make some decent returns. But if it goes the other way, it won't wipe you out if you lose all of that 10% invested. Why cryptocurrencies? Well, the beauty of cryptocurrencies is you can buy in small fractions of a coin. We can spread that investment over a ton of different coins and build a portfolio of a multitude of cryptocurrencies. The cryptocurrency market is extremely volatile. It's not unusual to see 10, 20% swings in a day. You're gonna learn really quickly how a market works and how an exchange works. I would recommend downloading Coinbase and downloading Bittrex. I would buy Bitcoin, Litecoin, Ethereum, Monero, Ripple, any coins that interest you, buy a coin and then just track their performance. You want to look at the market, see how it's performing, and really research and understand what is happening and why it's so volatile. You'll see really quickly this is a roller coaster with ups, downs, and twists and turns. With £100 invested, don't jump in and out, just keep your money in there and enjoy the ride. So invest 5 to 10% using Coinbase and Bittrex into high risk investments, cryptocurrencies. I'd really recommend not going above that 10%, and as you invest more and more, I would aim to have that 10% shrink the more money that you actually accumulate and invest. So the third investment is index tracker funds. I'd recommend putting 80 to 90% of that £1,000 into index trackers. An index tracker fund has lots of companies within it. So it means your money is going to be spread across hundreds of different companies and bonds. It's a mutual fund that allows you to track certain markets. So instead of buying individual and hand-picking stocks, you're going to put your money into a whole market. For example, the US economy or the UK economy or emerging markets. Build a diversified portfolio across that market. It's not actively managed, so the fees are super low and the performance will beat any managed fund or any individual stock in the long run. So I'd recommend opening a Vanguard account. It's super simple to set up, and they have a great dashboard that you can see the progress and the performance of your portfolio and dig into the details of all of your funds. They don't have too many funds to choose from, but sometimes that is a good thing, and actually the ones they do have are world class. Even within index funds, you want to buy a multitude of different funds. So you further diversify and you spread the risk across different investments. I would say pick a couple of developed countries. I like America and UK. I live in the UK. I think the economy is going to go really well in the next few years. And the US has absolutely crushed it over the last 5 or 10 years. So I'm making a bet on these 2 developed countries. And I also think we're going to see a lot of growth in countries like China, India, Indonesia, Egypt, Turkey. These are the big developing countries. So I want to put a bet on emerging markets as well. So on a weekly basis, go into the tracker, go into the dashboard and track the progress and try and understand what are the key drivers behind that performance. Woo! What we're going to look at now is the benefits of compound interest. So really, why this £1,000 is important is that you want to get started straight away. And if you can start early enough, you can really leverage the benefits of compound interest. Compound interest essentially is any benefit or interest that you gain through your investments, you reinvest the benefits. And then as your portfolio slowly builds and builds, that snowball effect can be really powerful. So let's check it out now. Go to Google and type in compound interest calculator, right? First one is fine, thecalculatorsite.com. Put in the initial amount that you're going to invest. So the base amount, which is £1,000 for us, and we're going to change our currencies to pounds. Historic performance of the S&P, which is American market, has been somewhere between like 7 and 10% if you take like a 100-year average. So we're going to be conservative and put 7%. Put your interest rate as 7%. Calculated period of 30. Let's say you're 25 and you're just getting started. You want to retire at 55, which actually for most would be pretty decent. Let's see if you invested £1,000 at 7% interest a year over 30 years, how much that would be. So compound interval will say monthly and regular deposits will say 0. Let's say you don't put anything else after that initial £1,000. Calculate. Boom, here. Your initial investment on your first year will be £1,072.29. So after 1 year, you would have gained £72.29. But if you go all the way, this is what we're looking for, all the way to the 30-year mark, you can see that £1,000 has turned into £8,116.50. So you have times 8 your money just by investing £1,000 and waiting 30 years and taking advantage and leveraging the benefits of compound interest. Let's really ramp this up. Let's say you have an initial £1,000 and let's say it all goes great and you do a 9% interest rate over that 30-year period and you're going to boost it £100 every single month. Let's calculate. Boom, let's take it to that real cheddar cheese all the way to the 30-year mark. Woo! You have got £200,000. So, £1,000 initial investment, £100 top up every single month at 9% return rate, which is good, which is healthy, but that's historic what America's markets has gained by each year. You'll be in 30 years sitting on 200K. Very nice. Dude, that's sick. Take it back again, £1,000 base amount, 10% interest over 30 years, 0% depositing again every month. Calculate, go to that 30-year mark. At a 10% return rate, you're sitting on 20K just by investing £1,000 and waiting 30 years. What I want to really demonstrate here is not that if you invest £1,000, you can retire off the equity you've gained in 30 years, because it looked at it was about 8 to 20 grand, depending on how much interest you've gained throughout the 30 year. But it was to really highlight the compound interest and the power of compound interest if you can get started earlier. And if you put £1,000 in initially and you top that up by what is kind of a small amount, £100 a month, you'll be sat on what is a pretty big nest egg, what is a pretty big pot after a few years. So number one, I would invest it into learning, into your education, into knowledge. Second portion of that £1,000, which I'd put 5 to 10%, is high risk investments. And number three is index tracker funds. Allocate 80 to 90% of that £1,000 to index tracker funds. And we just want to get started early so we can take advantage and leverage the benefits of compound interest. For future investments, keep the ratios pretty similar. If you get another £1,000, I would allocate the bulk of that to index tracker funds and a smaller proportion to a high risk investments like cryptocurrencies and a small sliver into your own knowledge. So buy a couple of books and subscribe to maybe a couple of magazines. Once we're looking 5 figures, so 10K plus, that's when, because that's some real cheddar, that's when we start talking about property. Thank you so much for watching. That was my advice on how to best invest £1,000. I pretty much follow the ratios that I've just laid out in this video. I've just invested £1,000 and I put most of that into Vanguard funds, index tracker funds, but I also topped up my cryptocurrency holding, and every single month I invest in myself, into learning. So I buy newsletters, a few there that you're looking at are magazines that I invest in. I have a whole host of different books on my bookcase, but put the bulk into index tracker funds and you can't go wrong. I'm going to do another video on how to invest £10,000 and we're going to touch on properties. Please like, subscribe, share, comment below. Thank you. Boom.